A lot of volatility today in the stock markets as the S&P 500 drops by nearly 2%. What exactly happened and what is about to happen next? Joining us today to break this down is Chris Vermeulen, Chief Market Strategist at thetechnicaltraders.com. Chris is a veteran trader who is going to share with us his short-term and long-term forecast and also explain to us his trading methodology. We'll put a link down in the description below of thetechnicaltraders.com. Welcome to the show. Welcome, Chris, to the David Lynn Report. Pleasure to host you today.
Hey, thanks for having me, David. Always a pleasure.
First, let's talk about short-term action. As we're speaking today on Thursday, March the 9th, big sell-off happening in the S&P 500. Things are starting to look red. People are getting worried. Are you worried?
Yeah, this today could be a turnaround week or turnaround day for the stock market. If I show my charts here, I can give you kind of a bit of a visual. If we go over to the SP 500, my trading strategy, we can see here the daily chart on the left-hand side is telling us when more or less the market is trending up and it's healthy to be in the market or in stocks. Red means it's a time you want to avoid the stock market or potentially be in a net short position. If we take a look at today's bar, which is this Thursday, as you and I are recording this, we've got a red bar. Now, the strategy is based on a closing price, so who knows if the market will recover by the end of the day. Maybe it doesn't turn red, but more or less, when we get a red bar, we typically see the market start to roll over and sell off. And this is potentially a big turning point. The stock market's been kind of, you could argue here, rising in kind of a channel where it's been channeling up and to the right for the last few months here. And if it breaks down through this channel, it could be a fairly significant breakdown and start to really sell off. And it could pull a lot of stocks down with it. The market, though, is on the verge of a big rally as well. We've got kind of the market testing the 200-day moving average. A lot of the indexes had a bounce off the 200-day moving average just about a week and a half ago. So we're right back down to those levels, and the market is just teetering on the point of another big leg to the downside or potentially to recover here and start a big rally. And it's been interesting because growth stocks have been doing very well and holding up a lot better than the SP 500, the Dow, over the last several months. And typically that's a good sign to the upside. But right now, this market, based on technicals and cycles, which you and I can get into, it is looking like the market is turning over today, and there might be a lot lower prices just around the corner.
On a short-term basis, on an intraday basis, Chris, would you say that the technicals indicate things are being oversold?
I would. So if we look at this 30-minute chart, let me just pull it right up and zoom in a little bit here. If we look at this 30-minute chart of the market, more or less, I've got these red shaded areas on the chart, which are indicating short-term overbought territories. When its background is shaded red, it's overbought. When it's shaded green, the market's oversold. Now, if something pushes too far, if something gets too overbought, it can actually break the downtrend and start a new uptrend, which turns into green bars. We've had it get oversold a few times over the past few weeks. And then just recently, just this week alone, we saw it push up into the overbought territory. It was on the verge of kind of kicking back into a new uptrend, but instead sellers have come back in. They continue to pull the market down and it's testing these lows. So it was overbought a few days ago. Now it's coming right back down to support. And we're starting to see some panic selling in the market, which is one of the short-term tools that I like to look at here. When we get panic selling in the market, we tend to find the market usually puts in some type of bounce that can last a couple of days. And so that's kind of what we're looking for, is a bounce down near this support level and see if this market can actually hold its ground and start to go higher, or if it's actually going to break this low. And, I think the bottom could fall out and we could see a very big collapse and drop in the market. So short-term wise, we're back to a bearish phase and we're trading at short-term support. And there was a lot of panic in the market. People are unloading shares today. There's a lot of volume to the downside of people just dumping shares. So definitely a bearish day on the market.
What's causing the sell-off, you think, today?
Yeah, I think, Powell, he created this big kind of drop in the market. I think people are still digesting it. I think there's a lot more talk about, the yields, inverse yields, rates continuing to go up. A lot of talk about recessions just around the corner. I think people are just hearing a lot of negative, and it's kind of a steady stream of selling. That's what we saw about 2 days ago. It wasn't big panic selling so much in the market. There was a little bit, but it was a steady trickle of selling pressure pulling the markets down. Today feels like there's a little bit more volume behind it, a little bit more fear. The VIX is starting to pop. So we're definitely seeing really people catching on to this kind of bearish move and starting to get a lot more panicky from the news that we heard just a couple of days ago. And I think it's just news driven more so than anything else. Just as price falls, it scares more and more people, and it starts to capitulate. Eventually, you get a wave of very sharp drop, which looks to be happening today, and it can be followed by a knee-jerk reaction, a bounce potentially in the next day or two for the market.
Now, Chris, just before we move on, top part of your chart, what are those indicators? Is that RSI, or what is that?
So these are more or less the way this is. This is the New York Stock Exchange volume ratio between the down volume divided by the up volume, and vice versa. So I color specific ones green. So when everybody's selling shares and everybody's panicking, just like they are today, that's usually when the market tries to carve out some type of bottom, and then you see a very short-lived bounce. It can be a 1-day or 3-day bounce. And the bottom one here is when you get into kind of greed buying, where everybody's buying, everybody's running to own shares. When that happens in an overbought market condition, you can see a strong pause or pullback in price. And that's exactly what we've seen. So when you put certain analysis together and you can, couple it with the market sentiment, which I look at this as the sentiment. This is the New York Stock Exchange, which is kind of known as the big board. Pretty much, if you were to go to the average Joe trader and say, pick a stock, they're probably going to pick a stock that is on the NASDAQ, on the New York Stock Exchange. And so I look at this volume as kind of like mass psychology. Everybody who owns the stocks on this are emotional driven. They don't understand technicals. So they're buying and selling usually at the wrong time on a short-term basis. And so when we take this information, we know when they're all selling, it's usually a good opportunity to start like locking in gains, because it's probably going to put in a bottom, have some type of bounce. When you're in an uptrend, you want to see everybody buying, and usually it means it's actually going to go the opposite way. It's going to sell off. So it's a great way to gauge the sentiment of short-term traders. If you're a day trader, momentum trader, I mean, this is an amazing tool to give you insight up to what people are doing and feeling.
Now, do you trade these short-term bounces, these intraday movements yourself?
Not very often. I mostly focus on like swing position trading. Occasionally, when we get like a perfect setup where in terms of an intraday move, a big sell-off, like today actually could be one of those days where everybody's shorting and driving the market down. We've got panic selling. Sometimes the last like hour of the day, I might start watching the charts and I might be looking for a short squeeze into the closing bell where everybody who's been shorting all day wants to cover their position. And once that downward trend stalls out and starts to turn up, it's a great opportunity to jump in and catch a really strong move to the upside. A good example of that actually is, let me just show you in the SPY. If we look at the SPY chart and I jump to the 10-minute chart, you can see that what happened yesterday with a very similar type of setup here. So the market ended up being traded sideways for most of the morning, but at the end of the day, you get this kind of big squeeze and pop to the upside. And that's what could potentially happen later today. We got this big move down as it starts to get exhausted, which is starting to look like it's getting tired here of selling pressure. When it starts to turn up here, we can see a very strong pop and squeeze up. And I like to trade those sometimes with futures, like an ES mini contract, because you can make, $500, $2,000 in, a 4 or 5 minute window. If you catch a nice pop and squeeze, or a 10-minute window. Again, this is a 10-minute chart. So it's a great way to take advantage of these short-term moves. I might see a couple of these a month that I just jump in really just to satisfy a trade. And, they're hard to pass up when you see them and you're sitting at the computer. You might as well jump in because it's not like you need to sit there for very long. It's usually half an hour or the final hour at some point. Keep you involved in the markets, but I do trade them sometimes, but it's not my focus, not focusing on day trading or anything like that.
All right, so let's go back to the direction now. You said that this sell-off is not over and you're anticipating more downside. How much further can we go then?
It depends on the time frame you're looking at. I think we're going to go into a very big sell-off in the stock market later this year. Big picture wise, I still think we're in like a stage 3 topping phase of the markets, which means a stage 4 comes after that. And stage 4 is like the 2001 bear market, which lasted a few years. It was also the 2008 bear market. And we haven't had one since that last time there. So if we go into another one, it's going to be a big collapse in the market. We could see the stock market fall 20, 30, 40% from where we are, catch a lot of people off guard, and it could create a lot of opportunity as long as you understand what the markets are doing and how to take advantage of those. So it could be a very pivotal year for people, for their finances, for their retirement. In the financial markets, we're probably going to look back and be like, wow, 2023 was a crazy year, standout year in terms of what the markets will do. So I think there's a lot of downside in this market. If we take a look at kind of this infographic that I created here, and more or less this breaks the market down into those 4 stages. And right now, I feel as though we're in this stage 3 topping phase. The market's trying to move higher, but it's struggling in a big way. Eventually, when it rolls over, it's going to go into a stage 4 decline. And this is a 2001, 2008. This is a major financial reset for stocks, commodities, real estate. I mean, businesses in general. This is where layoffs, happen left, right, and center. Businesses go out of business, defaults across the board. So that's what we could be potentially going into. And I think it's just around the corner, and we need to be very aware of this because if you and I were to kind of drop down to the cycles that you were mentioning earlier, if we look at these 2 cycles, there's the blue cycle, which is the stock market cycle, and then there's the yellow one, which is the economic cycle. Now, the stock market typically tops well before the economy, and it usually bottoms before the economy does as well. And the reason is investors can look forward, they can see forecasts for companies saying, oh, we see businesses, it's stalling out, we're not getting as many sales, we need to lay people off. So investors start to move out of the stock because they don't believe that it's going to continue to grow. So the stock market will start to top down before we get enough economic data, quarter after quarter of bad news that, triggers the official recession. And so, last year and the year before, we saw energy do very well. In the past several months, we've seen precious metals. They came to life for a while. They were leading the way, and now they're starting to get a little exhausted and running out of steam. And they're the last 2 major sectors before the stock market kind of goes into this big downward cycle to the downside. And that's not a good thing. So we're very close to a big move down just based on the sector rotation, based on chart patterns. All these things are kind of coming together, especially with the rates. I think there's going to be a very interesting play down the road eventually where bonds were one of the worst assets over the last few years. It could end up becoming one of the best assets going forward. Once the rates more or less come to a grinding halt, I think there's going to be a lot of upside because bonds, I think, will rally as the rates start to get cut. And the Fed has loaded their gun with a ton of rate cuts. But we're not there yet. I mean, the rates could keep going up. As you know, they're talking 6% handle potentially now.
All right, I do want to get to asset allocation in just a bit, but can we go back to your chart? Can we go back to your live S&P 500 chart? I just want to point something out. So help us understand how you're interpreting this chart and how that relates to the cycles that you were just talking about. If I were to just look at the blue line, one of the moving averages you have there, over the last couple of months since October, since the bottom of October, it looks to me like it's been on an uptrend. So what makes you think, just looking at that this uptrend won't continue indefinitely?
It very much could. I mean, when you look at it from this standpoint, the market is making a series of higher lows. It's making a series of higher highs. It is pulling down to a support level. The way I look at it with my strategy is I use a lot of different analysis behind the scenes. So I use some cycles. I use a lot of intermarket analysis. So I like to see what different commodities, sectors, assets are doing in relation to the stock index itself. And the reason we're getting a red bar today is because, well, the stock market hasn't really broken down from a full-on technical standpoint. All the underlying strengths is telling us money is flowing away from risk on. They're dumping stocks, and you don't want to be holding it more or less. My strategy tries to ride the coattails of the big money flow, and it's looking at the whole picture of the stock market between different commodities and sectors and asset classes. And when the big money starts to flow out of stocks and into different areas, that's not a good sign. We want to do the same. So the red bar is telling us big money is fleeing the market. It's time to get out. And if we get a sell signal, we can potentially take advantage to the next drop in price or look for something that is rising in value as the stock market falls.
Well, Chris, tell us a personal story then. At what point in your career did you decide, or did you find out that these cycles work for you as a trader? Presumably, you could have picked other technical trading strategies, right?
For sure. Yeah. Well, I mean, cycles is just one aspect of it because I believe there's a lot of different areas of the market. I think cycles are one of my key things. And I kind of learned cycles in 2001. That was when I really got the gist of it. I was at, I can't remember, it was a Investor Toolbox. It was the company back then, might still be in business, but it was a seminar in Toronto. I went for the weekend. It was a few $1,000s. And this guy was teaching about cycles and I just fell in love with it. And I realized, okay, well, there's typical, cycles through the stock market. And I find cycles work the best with the stock market only. That's what I really focus on because we have weekly, biweekly, monthly, like options expiry. We've got people getting weekly, buy like every 2 weeks they get paid, every monthly, and people put portion of their money, their paychecks into the stock market. I mean, there's economic data on a weekly, quarterly basis. So there's all these things that constantly repeat month after month, year after year. And so the stock market has this typical kind of wave-like pattern. Some waves are bigger than others. And so that's what when I really took a hold of that, I was like, I like the cycles. There's regular cyclical patterns in the stock market of money flowing in, money flowing out. So that was one aspect. The other one is kind of looking at almost like standard deviation in terms of, has the market moved too far too fast? If it rallies up or drops too quickly, typically bargain hunters will step in. If it drops really quick, people will step in and kind of buy up the oversold condition. If it rallies too fast to the upside, people will quickly sell and lock in the quick gains. So there's just momentum is another one that I like to look at. And then I like to also look at how the market moves in relation to utilities or gold or, all kinds of different plays that you can look at and be like, okay, well, is money flowing in or out of defensive plays? And how are all those things moving together? So I kind of put all this together over the years, merging them together along with technical analysis. And it kind of gives you the full round of time frame, gives you a momentum. Of course, the panic selling indicator telling us when people are running for the door or buying stocks hand over fist. All these little things, when they come together, generate like a buy signal or a sell signal. So that's kind of in a nutshell what I look for. And I kind of got into the whole technical side, which was kind of 2001 when I was buying into some stocks that were doing really well in terms of financial. They were growing, yet the stock prices kept plummeting, and I got really frustrated. Seeing companies have good earnings and the prices were just still free falling, and I lost a lot of money. And that was when I realized, okay, fundamentals to me make no sense, especially during a bear market. And I wanted to just follow price. And as soon as I started following price using technical analysis, which I read the big, thick Bible from John Murphy, Technical Analysis of the Financial Markets. Once I read that and understood how everything is related to each other and how to identify trends and overbought, oversold conditions, I was sold. I was like, okay, I'm just going to identify the trend and the time frame that I want to focus on trading. And I'm just going to apply the tools. I'm going to create a checklist and do a strategy based around it and just follow it. And that's where I kind of came into this whole strategy.
Just on the note on fundamentals not working for you as a trader, this is one criticism I've heard of fundamental analysis when it comes to trading. We're using fundamental analysis for trading. I remember when I first started in my career right after college, my first job was at a macro research firm. And one of the first managers I worked with told me that value is possibly the worst indicator of where price is going. Something could be cheap on a valuation basis or expensive on a valuation basis, depending on which metrics you're using. Mm-hmm. It doesn't necessarily mean that the cheaply valued stock is going to go up anytime soon. Could be a value trap, could stay low for years. We don't know. So just because something looks cheap doesn't mean you should buy it. And I think that I'll let you evaluate that statement. Maybe valuations are just a poor tool for trading. Do you agree or disagree?
Yeah, I think they're a poor tool. I mean, really the value is what people think it's worth, right? I mean, Elon Musk is asked all the time. People are like, should I buy your stock? And he's like, I don't know. He says it's overpriced. I mean, right? It really comes down to what you think the value is. I mean, the current share price is the value that the people interested in it on put value at that particular price for that day. But I agree. I think price is a really poor indicator. Like the PE ratios and all that stuff. I think they're interesting to know, when things are overvalued compared to historical PE ratios, but it gives you no indication of when it's overbought, like when it's actually going to start to top out and fall, or when it's super cheap. And I've seen this all the time where you see the better company doesn't do very well in terms of stock price, but the competitor is like crushing it and the stock price is surging. So it really, it's a real crapshoot in terms of fundamental of, it's more so marketing, it's sentiment, who's got the best, image in investors' head, where's the crowd moving? And once they've got that momentum, people tell other people, I just bought this stock, and it creates this feeding frenzy. So it really doesn't have much to do, I think, with the value of the stock or what people kind of put on it.
It's an entirely different way of thinking of owning and selling securities. When I was in college in finance class, one of my favorite asset management professors taught us one of the things that he taught us to do was to sell your stock as soon as it reaches a target value. This is more for long-term holders. It's not a trading strategy per se. But you do your discounted cash flow analysis, your standard valuation stuff. And once your fundamental analysis tells you that a certain value is to be designated to that stock, you buy and hold and wait until that stock reaches that value. And as soon as it does, you sell. Now, I don't know how you think that strategy works out for you, but do you have a similar sort of short-term strategy whereby you set targets for yourself, and once those targets are met, you sell or buy? And how do you determine these targets?
Yeah, for sure. So I think you have to put targets out. I think going in for your trading strategy, you have to have everything figured out before you get into the trade. So for example, if we get into, say, the SP 500, for example, once we get in, we put a stop in place in case it rolls over and something happens. We always want to have an order standing in the market. And I think orders in the market are really good in terms of the indexes. When you get individual stocks, it's a bit different story. But when you're trading ETFs and major indexes, you want to put a stop in place, especially if you're trading a large amount of money. And then once you've got the stop in place, we like to place our target orders. So I'll pick, depending on the volatility, depending on how strong a trend is, we might have a 3 or a 5% first target, where if we reach that level, we're going to sell 25 or 50% of that position. Again, depending on the market setup, how strong or weak the market is, and let that trade mature. And sometimes we'll go and blast through that target and keep on going to our next target. Or sometimes the market will just roll over and we won't hit any target, just like what we have now. We got into the SP 500. It hasn't really taken off and hit our first target. And it looks like we could have a trend exit signal today. So we're just going to get out of it. We don't wait for the stop to get hit. We get out when the market tells us, hey, yeah, trade didn't work out. Things look like they're turning around. Get out and protect your capital. And that's the key, is it's all about protecting your capital. And if you just, go out there and buy something and hope for it to reach a certain value, I mean, in the market condition like we're in now, it could take years for something to recover if we go into a big stage 4 decline, a big bear market, a real bear market later this year. And it could take 2 or 3 years to recover. And it'll be one heck of a painful roller coaster ride. And if you're into individual stocks, they typically take a lot longer individually to recover and come back. So there's definitely, you got to have a trading plan. You have to have targets. You need to be scaling out.
Why do you trade the indices more than individual stocks?
I really like them because, again, I traded stocks, I've traded options, I've day traded futures, I've kind of done everything. And that's the way my mindset is. I always like to go out and learn from the ground up, test the waters on everything and figure out what I like the best, what my brain seems to click with. Everybody sees the market differently, and they all want to trade on a different time frame, different vehicle. To me, the indexes, as I mentioned before, have got the most cyclical price action because of economic events, because of money flows in and out from paychecks and all kinds of different things like that. So if I can gauge what the stock market is doing, if it's going up or down, then it allows me to send kind of a ripple effect of how that's going to affect on all kinds of different assets, because everything's really intermarket related. So if something's going up, something else is most likely going down. And if you can nail down the stock market, then I think you've got most of the picture figured out, and then you can go and trade other assets when the stock market's not favorable. And I like ETFs because ETFs, they have a market maker. They have to fill your order with shares. They move slower than an individual stock, and you can trade large amounts of money with the ETFs. You get into individual stocks or options trading, you can barely put in a half decent trade without moving the share price 1, 2, 3%, or pushing an options contract really far out of reach, or putting a limit order trying to get into it and you don't get filled. So ETFs to me are like, especially on the indexes, bonds, the US dollar is, I like it because they move like an ocean. There's beautiful wave-like patterns. They move usually at different times, so they're not directly related to each other. And you can just dump in a large amount of money. And because they're slow-moving assets, you can put more money to work than an individual little stock that's really volatile, and you don't want to risk much of your portfolio in it.
Now, how much cash are you sitting on right now relative to the rest of your position?
Well, if we get out today, we'll be back to 100% cash. We've been long the SP 500 and the NASDAQ. We hit a target on our NASDAQ a couple of weeks ago. So we'll be back to 100% cash. And depending on how the market closes, we'll see if there's a different play to enter tomorrow that potentially could rally as the stock market falls. So we just need to see how everything shakes out on the day.
So tell us when you're getting, or how you're getting back in. Tell us some of these signals you're looking at that would indicate to you that it's safe to get back in, assuming you're out and into cash by tomorrow.
Yeah, so we'll be, one of the basic criteria is we want to see price above the 50-day moving average. Is the most basic criteria, but typically if the price is above the 50-day and it's holding up, that is one of the criteria. I mean, I use a lot of different proprietary tools for timing, for identifying when the actual big money is flowing into the market, and we want to ride those coattails. It's like riding behind a giant transport trailer truck. You can just draft, you get in its draft and you don't even feel any wind, and you can just cruise. And that's what we try and do with the stock market. We figure out what all the big money's doing, where the stampede, the money is flowing. And then we just, once it's clear which direction it's going, we just kind of swing in behind it and we just ride that, get in that draft and ride that trend. So there's a lot of things that come into play. Most of it is the technicals, the cycles, the volume flows, intermarket analysis. I mean, I'm not going to go into the details, but there's a lot that goes into it that tells us when the bar turns red or green. It's not something basic. There's a lot of calculations. We actually need to let the markets close and let the market kind of calibrate itself before we get the signal. It's not like we get it right at the close either. So,
okay, Chris, final question. What are some common trading mistakes that you see other people make, or perhaps you're convinced you're training yourself not to repeat yourself? And how can people rectify these mistakes?
Yeah, I think a lot of people get sucked into watching the intraday price action, listening to the news, and it's a great way to get your emotions in the way of trades and to usually get on the wrong side of trades. The short-term intraday charts are really, really noisy, and it is very easy to get stuck in that roller coaster ride, especially if you're a long-term investor. So many long-term investors watch and refresh their charts and check their phone all day. I mean, it really wreaks havoc in terms of the stress level. It makes you start second guessing yourself. I think the big thing is really just to try to when you place an order, make sure you know if it falls to a certain level, where are you getting out? If it rallies a certain amount, are you going to be taking some partial profits? And if you do, what are you going to do with your protective stop? You need to move those up. So most people get into a trade without a plan, other than I want to buy it, I think it's going up, and then they get in and they don't know what to do. So the key here is to really create a checklist, a plan. If you get into this trade, if it falls so much, at what point do you say, I'm going to get out because it's failed? I think protective stops, while nobody likes having a stop get hit, if you're getting stops hit, it actually means you've got rules in place. It means you're focusing, you got the self-discipline to take the hit, to take the beating. I hate getting stopped out. It just makes my gut turn. But, once I get stopped out, I'm like, okay, we're out of that trade. Now it's done. We can move on. It's just part of trading. If you don't have stops getting hit, if you don't place them and they don't get hit, you really don't know what you're doing, because you're just letting things free fall. And eventually things fall so far that you feel like you can't sell it anymore because you've lost too much. And it's like this downward spiral. And that's what's really bad about a bear market is things get bad. And then they get to the point where they're so bad that the people think they can't get out of them. And they just keep holding it and they ride the bear market down. And a lot of these assets and sectors fall huge percentage wise compared to the index. And people they all have their favorite stocks. They have their favorite sectors. And it doesn't matter which one you get in, those individual sectors that you're probably heavyweight in will get hit like 50, 70, 80% during a major market correction. So, I mean, the biggest tip would be put a stop in place. At worst, just put a stop in place so that when it goes against you, you're out. You're better to let something run than you are to let it fall and keep falling.
Chris, finally, where can we learn more about thetechnicaltraders.com and your services?
Sure. Yeah. You can go to thetechnicaltraders.com. And there I've got a blog that's got lots of great content, a lot around the psychology of trading, technical analysis, how you need to apply all these things to really get around the emotional aspect of the markets. And every morning for clients, I do pre-market video. I run through all the charts. We talk about all the key assets and we talk about what to expect each day. And of course, every trade that I put on with an ETF, I share with subscribers. I follow a strategy called CGS, which stands for the Consistent Growth Strategy. And it's focusing more so on kind of passive investors who want to be active and they don't want to hold during a bear market. They want to take advantage of falling prices. They want to take advantage of rallies. So that's a strategy that I focus on with investors who got a large amount of money. They want to be able to manage it safely because this year is going to be one crazy year. And it's all about protecting capital. And when the market's primed and ready, we want to get in and take advantage of either rising or falling markets. So that's a strategy where I provide the trade analysis to subscribers each day.
All right, Chris. Well, we'll put the link down below. Thank you for coming on my show, The David Lynn Report. I look forward to speaking with you again.
Thanks, David. Take care.
And thank you for watching. I'm David Lynn. Stay tuned.